Emerging markets have often been at the mercy of global rate cycles, but this time EM central banks are leading the way, tightening early, taming inflation, and now potentially preparing to ease before the Fed. Is this a turning point for emerging market assets? We're going to break that all down for you right now, right here on UBS Trending. Hi, everyone, and thank you so much for joining me. I'm Anthony Pastore, and this is UBS Trending. And back in the studio with me is Alejo Cherwanko, Chief Investment Officer for Emerging Markets here at UBS. Alejo, thanks for coming in.
Always great to be here.
It's interesting because this time it's kind of timed around the U.S. Federal Reserve. There's been a lot of talk about the Fed, particularly the independence of the Fed, which we are going to get into. But we did, as we're sitting here today, have the end of a two-day Fed meeting where the Federal Reserve did decide to hold rates unchanged. We'll get into that as well. But with Jay Powell, who's the head of the Federal Reserve, the chair, he has a quote about price stability, and I think it really sums up exactly what he's always trying to explain at every press conference and in every statement. Go through that with us because I think it sets up really interestingly the conversation we're going to have about EM central banks today.
You're spot on. Just about every time Powell speaks, he repeats some version of a phrase that goes something like, without price stability, the economy doesn't work for anybody. Mm-hmm. And what I think he means by that is that we've learned, sometimes the hard way, that an economy with 2%-ish inflation is an economy that operates at its best. Inflation too high above that, and you become Venezuela, Zimbabwe, right? The economy breaks down. Inflation too low below that, and the economy becomes Japan, up until a couple of years ago, where individuals delay purchase decisions because you're in a deflationary environment. So we've learned 2% is by and large the right target, and central bank independence is the best institutional setup to achieve that. I mean, central bank decisions, monetary policy decisions that are at arm's length from the executive power of any given country.
Well, I mean, if you look at the independence of central banks all over the world, developed, emerging here in the U.S., when you look at that, the autonomous central banks have had the strongest ability to maintain an inflation rate that is manageable at whatever their rate is in their individual country, 2%, as you said, for here, for example, in the United States. So it's interesting to see that even the fact that independence of central banks comes into question, given historically autonomy works for central banks.
I think you're right. History speaks for itself. Before developed and emerging markets adopted central bank independence en masse and inflation targeting regimes en masse, inflation was an issue just about everywhere. And since then, we have practically, by and large, resolved it. Not every single time we're going to get it right, but we've seen a lot better price environments over the last 40 years than any time before.
And interestingly, at today's meeting, and we're looking at inflation now that is pretty close to that 2% target, 2.5%, 3%. There were two Fed governors who dissented, who wanted to cut rates at the meeting today, which is the first time we've seen two dissensions since 1993 here in the U.S. So that also begs the question is, what then happens next? Does Powell feel challenged by those two dissenters, or is it business as usual? We vote democratically as governors. There's, as you said, 9 others in the room besides the two that said, no, we want to cut rates today. So how does that feel for Powell? What does he have to, or what is he thinking about when he sees that happen?
Historical development indeed. Two dissenters, we haven't seen that since 1993, but at the same time, 9 governors voted homogeneously. Mm-hmm. And I do think that the decision will be made in general by consensus on a forward-looking basis. Our expectation at CIO is that we will see 100 basis points of interest rate cuts over the next 12 months. But the data has to come in line with the Fed's expectations for this to materialize.
Right, of course. So let me move over to then emerging markets with you, since this is where you're really focusing on. Most of the emerging market countries moved to central bank independence sometime around the 90s. Why is that such a big deal?
I think you gotta remember the very tough 1980s and 1990s for the emerging world. You saw economic instability, financial and economic crisis being recurrent. Emerging markets learned the tough way that they had to reform and adapt different institutional setups. When it comes to monetary policy, it was central bank independence and inflation targeted that was most convincing. And starting mid-90s, emerging markets started to adopt these types of systems. The reality is inflation has collapsed since. Let me give you one concrete example, 2024. Looking at the 25 largest emerging markets, the median inflation was 2.9%, right? So we've got price stability in the emerging world, I think, in good part because of central bank independence and inflation targeting.
Yeah, it's interesting. I was looking at a chart of Venezuela right before we walked in, and there were some periods in Venezuela, when you look at their consumer price index, their CPI, that they were looking at 30-40% inflation quarter over quarter. There was one period where it was up 196%. And so you can see clearly, and now, by the way, for the last year or so, there's been more stability according to the numbers. I'm just using Venezuela as an example because there's such extremes. But you can see the benefit of that in like targeting inflation and price stability right in the chart itself. I mean, the numbers don't lie.
That's right. I mean, Venezuela is the perfect example of what not to do.
Right.
It is an economy that has always maintained a lot of political influence over monetary policy, and therefore it's been many, many years of inflation struggles in Venezuela. That's the odd one out. But once again, look at the 25 largest emerging market countries. They've got it by and large under control. And that's a big deal, right, for investors.
And since the 90s, we're saying here, for those 25.
It was an evolution.
Yeah, sure. Not
that
overnight.
led up to the successes of today.
So let's look at that then. So when you look at those 25 countries, when they were either hiking or whether they were cutting, with that target of making sure their inflation numbers were steady with the economy that they were looking to achieve, did it work? And how did you see sort of the benefits of that come into play? Because if they went from no independence and really not having an inflation target to then, as you said, gradually going that direction, talk about the benefits you saw.
Yeah, I think the experience over the last 5 years with the pandemic inflation surge prove quite informative, right? You saw that emerging markets that had the freshest memory of inflationary episodes, their central banks hiked ahead of the Fed. That allowed them to build credibility, to contain inflation, and subsequently, they could cut ahead of the Fed, right? So in a way, you could think about emerging market central banks being ahead of the curve this time around, given their idiosyncratic experiences. And I think by and large, this is a good thing.
Well, now they've had a couple of decades to
learn.
Exactly, and grow and see what's working.
Yes.
Which is amazing to see. And as you said, getting ahead of the curve versus the U.S. Federal Reserve, which is the benchmark. It's the pinnacle of every central bank around the world.
That's a big deal.
It's a big deal. So that's amazing. So for those who have been investor-wise, who have been cautious on emerging markets, which we've been saying, you and I in this room for many years now, that having an allocation to emerging markets in most portfolios is part of a well-diversified general portfolio. So does the central bank story then kind of tip the scales at all? Or is your conviction on EM the same given the history of the central banks and their ability to, as you said, learn and grow and move when the timing was right?
The central bank story is part of the equation. But I think more broadly, we have to recognize that the lines that historically divided emerging markets, developed markets, they are blurring. Let me give you a few examples. Historically, you'd think emerging markets have low GDP per capita, have high poverty. But now you think about the UAE, Korea, the Czech Republic, Chile, all countries with pretty high GDP per capita, low poverty levels. Or if you consider historical preconceptions around low manufacturing base. But then you think about Brazil, aerospace industry, or Taiwan, chip making capacity, or Poland, very advanced supply chains, so that dispels that notion. Or if you think about historically, you'd think emerging markets are subject to high levels of policy and politics uncertainty.
Right.
I think that's become commonplace, right, these days. So the gap between emerging markets, developed markets has shrunk. I think it will continue to shrink. And so your portfolio needs to reflect this reality. Granted, emerging market capital markets are shallower, asset prices are more volatile, but nonetheless, they can add quite a bit of value to global portfolios.
Yeah, thanks, Alejo. It is fascinating as you go through the data. I mean, as we say, numbers don't lie. I say that all the time. As you go through the data, you can see the world in some ways shrinking in the sense of how each player, country-wise, reacts to another. So whether you're a developed country or an emerging country, almost, as you say, the lines are a little bit more blurred than they were even a decade ago. I bet there are a lot of people out there who don't realize that China is still considered an emerging economy. They would imagine that China, that has, so many billionaires and big tech and industry, would be a developed country, but it's not there yet. So there are those blurry lines, which I think will continue to move. And these conversations that you and I will be having over time are even getting even more interesting as we're looking at how the evolution of emerging markets will continue to progress.
Totally.
Yeah.
Some emerging markets are emerging, some developed markets are submerging. The reality is we're getting some degree of convergence.
Right. Thank you, Alejo. Good to see you as always.
Thank you for having me.
Thank you, my friend. And thank you all for joining us. There's a lot more information from everything coming out of the CIO research team, where Alejo and his team sit. You can find those at ubs.com/views. That is our insights page. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. You can also check out our dedicated Instagram channel at UBS Trending. Lots of content there for you. And as always, if you have any questions about what Alejo and I spoke about today, please continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.